Hello traders, how are you? This is Wanjuru Kishangi of Forex Exploits Online Academy. I hope you've been well. I hope you've enjoyed the other previous video, especially the candlestick pattern video. This is part 2 of the patterns part. Today, I want to do a session on chart patterns. Chart patterns. It's very important that you first master the candlestick pattern video that I did some few days ago, and then get to this video on chart patterns, because these two videos will work best together. You can also watch the trend line video, and therefore you can have the three videos. Just use them entirely for your trading. These will give you a very stable trend trading style. Note, these three videos are best if traded with the trend. If you're new on this channel, this is your first time on the Forex Exploits channel, be kind to watch the other videos. If you're just starting out, watch the very first video and master the market structure video. This is your backbone video as far as trading is concerned. So make sure that you have the right information, or you have mastered this video as you embark on your trading journey. This is the video that I'm talking about, the important candlestick patterns. These will work perfectly with this current video. So pause this video at this time, pause it, first watch the candlestick pattern, then use that knowledge together with the knowledge of this session and the trend line video, and you're good to go as far as price action and chart trading is concerned. Again, if you have feedback, if you have a video request, if you want to interact with me, you can find me on my social media. I have a page on Facebook with the name Forex Exploits Online Academy. This is where we do the interaction about the market. If you're a total beginner, we have a post in there with the title Beginners in the House. This is a pinned post, sorry, it's a pinned post. Therefore, this is what you get every time you get to my page. Be very diligent. Read everything on this page, because this is the welcome to the Forex trading journey, and it helps you to get started the right way. It talks about the brokers and how to join. Of course, there are also books on the same page. I've written books on Forex, so you can pick either depending with your level of skill. So interact with me, let me know your level of trading. And of course, if you have feedback, I have people who back test the videos that I do on YouTube, and they share their feedback. So again, feel free to share your feedback, your screenshots, your questions, and everything on this page. And if you're not on social media, again, you can find me on LinkedIn, same name, Forex Exploits Online Academy. Let's engage, let's make trading doable. And on this channel, share the videos, share the links with your trading. So what's the topic for today? The topic for today is important chart patterns. All my videos start from a beginner's perspective. So if you're new, you're in trading, you're in the right channel, because here we start from zero so that it's beneficial to everyone. Now, what's a chart pattern? What's a chart pattern? These are patterns. These are patterns. These are patterns within a chart when prices are graphed or plotted. They occur naturally and they repeat over period. What this means is these patterns will just happen as the market is plotting, as the price is moving. You find that they are consistent patterns that are happening. Those are what we call chart patterns. Now, the difference, if you're new and you don't know the difference between a chart pattern and a candlestick pattern, a candlestick pattern may be a 1 candlestick, 2 candlestick, or 3 candlestick pattern, but a chart pattern are more candlesticks together forming a visible pattern. So a chart pattern has many candlesticks, and actually the more the candlesticks on a chart pattern, the stronger the pattern is. So we will discuss that as we go. Now, when you're checking your chart patterns, what are the things to note? These are very important. What things should you note as far as chart patterns are concerned? One is the duration it takes for a chart pattern to form. The duration it takes for the chart pattern to form. This is in simple language. If you find a chart pattern on the 5 minute or the 1 minute time frame, and I find the same pattern on the 1 hour chart or the 4 hour chart, which one do you think is stronger? Which one has higher probability? Remember, forex trading is a probability business, so it's a probability field. So which among the two patterns have higher probability of holding up? Of course, it's the one on the higher time frame. That's why we're saying the higher, the longer, the stronger the signal. Then we have the size of the chart pattern. The size of the chart pattern, that is very important. The size of the chart pattern. The bigger the chart pattern, the better. Then we have location of the chart pattern. I have no way of overemphasizing location of patterns in the market. What is location of the pattern, or what does location of the chart mean? On the other video on candlestick pattern, I mentioned that any trend has 3 stages. We have the beginning or stage 1, we have the middle of stage 2, and we have the peak or end of stage 3. Now, these patterns will have meaning depending with where they are located. Are they seen at the beginning or stage 1? Are they seen at the middle, or are they seen at the end of the trend? So as much as you may be excited about learning chart patterns, also get the same excitement watching the first video, which is very important. Be very excited watching the first video on how to get started, so that you may understand the 3 stages of a trend. Very important. Then we have the volume in the pattern. The volume in the pattern. Now, the volume in the pattern means the push. How much volatility, how much business, how much money or items are being pushed. And how will you tell volume? Of course, you can use the RSI, you can use the TDI, you can use the volatility band. If you're using the TDI or the volatility band, you want to see expansion. You want to see expansion, because expansion basically means there's a lot of volume. There are also other volume indicators that you can find free on your trading platform. And the last and not least, we have the extra confluence. Now, the extra confluence is basically extra confirmation. Okay, extra confirmation. Now, extra confirmation, you can get it from indicators, maybe the RSI, the volume, or the GTI, but you can also get price action confirmation. When you talk about price action confirmation, this would be how the market is behaving at that particular point. Because what is price action? This is the behavior of the market at a price point. What is price action? This is the behavior of the market at a price point. So you want to see the candlestick patterns. You want to see the zones. You want to see how the market is pivoting at that particular point, and that you can use as extra confluence or extra confirmation. Now, how do we use these chart patterns? What are the uses of chart patterns? One, you may use it for entry of trades. You have the pattern, it has given you a breakout and retest, you use that for entry. So the most important for any trader is, of course, entry. You can also use the chart patterns to identify reversals. So you've been buying, and the market has been buying for quite a while, and you're at the last stage of the buying cycle, and you get a bearish reversal pattern. Of course, now you can identify that pattern as a reversal, and now you can prepare to pick that low, to pick that top or that low, and move to the opposite direction. So chart patterns can also be used for reversal identification. You can also use them for spotting continuation. Now, this is again based on the location. If you find these chart patterns at stage 2 or at the middle of a trending trend, at the middle of the trend, it can only mean one thing: continuation. This is why it's very important for you to understand the level you are on a trend, or to understand the stage that you're on your trend, so that you don't confuse a continuation pattern with a reversal pattern. A reversal cannot happen at the middle of the trend. It can only happen at stage 3. And note, a reversal pattern can also be a continuation pattern depending with location. Location is most important. Then you can also use the chart patterns to avoid bad trades. To avoid bad trades. How do you avoid bad trades? Now, while you're using your chart patterns and extra conference, or using price action as extra confirmation, you may find a breakout, but depending with the price action around that breakout, you identify it as a false breakout. If now everything points it to being a false breakout, are you going to join that trade? No, you're not. So what will you have done? You will have used the chart pattern and extra conference to avoid a bad trade. On the next video, I'll be maybe discussing how to identify false breakout, because that is something that I see so many people requesting on the exploits page on Facebook. So I'll be creating time to do a short video on false breakouts based on extra confluence and of course chart. Last and not least, we have determining stop loss and take profit zones. Now you use these chart patterns to determine stop loss and take profit. For example, if I may just maybe give one of the most common chart patterns, that would be the symmetrical rectangle. Not symmetrical rectangle, symmetrical triangle. This is a triangle that has equal halves. Now with this, if the market is coming from the bottom side, it gets to that symmetrical triangle and it's at the middle of the range, you expect the market to continue to the upside after maybe breaking the test, and then it continues to the top side. Now, if that happens, how are you going to determine the stop loss? Of course, your stop loss is supposed to be at your last swing low. At your last swing low, that's where you place your stop loss. And which is your first take profit? The size of this triangle, that size there, you just measure to the top, from the top to the bottom. Let's call this Y. Now, this Y should be your first TP. So you measure the same here. Okay, so your first TP should be Y. And of course, after Y, maybe the market will test, and then you can get. For me, how I usually do this, if I find it at the middle stage, I'm going to triple the Y. So I'll get the first TP as Y, retest, second TP as Y2, then another retest to the peak, which is Y3. So I get TP2, TP3, same size. But that is me. You can actually just refine it or change it to fit your trading style. Now, I'm not going to group these chart patterns based on reversal or continuation, because a continuation can also be a reversal based on the location. I just want to group them in terms of the bullish chart patterns and the bearish chart patterns. But again, I know everybody is itchy on knowing which are these patterns and of course how to use them. Google should be your friend. Okay, when you go to Google, you get all these chart patterns, but it's important, even though you're Googling them, it's important that you understand the location that they are showing up on your chart. So let's just mention some of the most important ones, because there is a list. There's a list here. Have a list of the bullish and the bearish ones. So we have the ascending triangle as a bullish pattern, the inverted head and shoulder, the falling or bullish wedge, the bullish flag, the bullish pennant, the double or triple bottom, the symmetrical triangle, and the rounding bottom. bottom. Now this rounding bottom, if it gets another retest, it becomes the cup and handle. For the bearish, we have the opposite of this, okay? Only that the cup and handle now just inverted or rounding top of the inverted cup and handle. So these patterns here, let's now get graphical. So let's have the bullish continuation. Now, something I want to mention when we're getting into more details on this is that when we're talking about the bullish continuation patterns, important. For the bullish continuation patterns, they should be found at stage 2. Very important. They should be found at stage 2 of the trend, or what we call the middle stage of the trend. Why? Because they are supposed to continue an already established trend. Okay, this is what I'm saying for beginners. A bullish trend pushes higher, creating higher highs, pushing higher, higher and higher. So if this is the start, so this is the initiation stage, or this is stage 1, I want to have my bullish continuation patterns at stage 2. I want to find it at the middle of my trend, because it's these patterns at the middle that will actually give me the confidence that the market has an extra push. So if I get these same patterns at the bottom here, they are not continuation patterns. If I find the same patterns at stage 3 or exhaustion point, they are not bullish continuation patterns. They only become bullish continuation patterns if they are at the middle stage. And which are some of these? An example is the ascending triangle. The ascending triangle. Now for the ascending triangle, the top is usually flat. The top is flat and the bottom is ascending. So the market is coming from the bottom. It gets to that, it hits that flat, okay, breaks it, retest, and continues to the top. Note the top is supposed to be straight. Now, where do you place your stop loss? Of course, you place your stop loss at the bottom side or the swing low, and then you take profit. The first TP should be that this length, you measure this, let's call it Y again. So your first TP should be Y, and then you can extend your TPs as the market is moving. The second one is the bullish wedge. Again, or the middle part, you want to see the market going up, and then it gets to a channel. This channel here now is equal distance channel. Okay, equal distance channel. So the market gets in there, does all that, and then breaks, retest, and goes. It's safe. It's safer if you can wait for a retest. But remember, nothing is cast on stone in this. Sorry, this. Let me repeat the bullish wedge once more. There was a mistake. Now for the bullish wedge, the market is coming from the bottom, then it gets to the channel, but the channel is narrowing, it's shrinking, it's narrowing to the end. Okay, very, very important. It's narrowing, so the market gets, when it gets to this narrow point, it breaks, maybe it gives a retest and it continues. Now for the bullish wedge, you really want to see this narrow and retest and go. Where do you place your stop loss? Of course, at the bottom here, your entry, and your first TP is this size, okay? Then you get your TP. Then the third one is the bullish flag. Now for the flag, the channel is of equal distance, okay? The channel is of equal distance, so we have the market coming from the bottom, gets in there, breaks, retest, then continues. And the last one on this group, we have the bullish symmetrical triangle. So we have that triangle that is of equal halves. The market is coming from the bottom side, gets in there. We have a break, retest, and the market continues. Now, the difference between the bullish wedge and the bullish flag is basically the slanting of the channel. Okay, the slanting of the channel. For the wedge, it will slant, or it becomes narrow at the end, but for the flag, it's equal distance. Okay, that's important to note. But again, remember, you don't have to struggle to keep memorizing these names or whatever. As long as you can understand the pattern and where the location at what it has, where it has been found, that's enough. Then we have the bearish continuation patterns. Now for the bearish continuation patterns, you want to find them at the middle stage of a downward trend. Now with downward trend, the market is pushing lower and lower and lower. So you don't want to find them at stage 1 and you don't want to find them at stage 3. You want to find them at the middle here, at the middle. Why? Because they give you the confidence that the market still has one more stage or one more push, okay? And it's very, very awesome if you find it on the higher time frame. It's usually very, very amazing or awesome. So these chart patterns, pay attention if they happen on the higher time frame, the 4 hour, the 1 hour, the daily, and so forth. Now, one of them is the descending triangle. The descending triangle. Now, with the descending triangle, the bottom is flat. The bottom line is flat, while the one coming from the top is slanting. So it's descending. The one at the bottom side is flat, and the other one is descending. So the market is coming from the top side, gets into that descending triangle, breaks it, retest, and you expect the market to continue downside. Pay attention, the bottom side is flat. Okay, the bottom side is flat, while the one descending is the one from the top. Then we have the bearish wedge. Now for a wedge, again, remember it narrows to the top side. It narrows to the top side. So the market is coming from the top, gets there, and when it gets to the narrow part, it breaks a retest and continue. Sometimes you may not get the retest. Sometimes you may not get the retest, so pay attention to the price action around this area. If it gives you a retest, even better. If it doesn't, now find some candlestick pattern and join in the trade. Then we have the bearish flag. For the bearish flag, the channel has equal distance, so it's not narrowing in on any side. The market is coming from the top, gets into the channel, then breaks, retest, pushes down. And the final one on this group is the bearish symmetrical triangle. So we have the triangle that has equal halves. The market gets into it, breaks, retests, and continues down. Again, for any continuation pattern, when the bearish ones, they should be found at the middle stage. If they are not found on the middle stage, forget about them being continuation patterns. Kindly pay attention to that, make your notes, and instead of memorizing the names, just maybe focus on the location and how they are formed. Then let me touch on the bullish, the reversal patterns, the bullish reversal patterns. Now, something to note about the bullish reversal patterns, so you can write this on your notebook, is that the bullish reversal patterns are supposed to be found at the end of a downtrend. So downtrend pushes lower, lower, lower. And when it gets to level 3 or the peak stage of the downtrend, this is where you expect to find this group of reversal patterns. They are bullish reversal patterns, meaning they are on stage 3 or the last or the peak stage of a downward trend, and they are showing that the market wants to reverse. If you're a swing trader, now these are the most important chart patterns to master, because they will help you to pick that bottom really well and help you to get in at the best optimal entry. So one of them is the double bottom. Now with the double bottom, you just have the W pattern for the BTM and trader. For the others, you just call it double bottom. So you have 1, 2. With the break of that neckline, you get into your trade. Your stop loss can be at the 50%, or if you had optimal entry at this point, maybe you can do 5 to 10 pips below that low. Your TP, of course, the first TP should be this this length here, the height here, let's call it Y. So your first TP can be Y, and maybe you add other TPs as you want. Then we have the triple bottom. With the triple bottom, instead of the market going to the top with the second, it comes back, gets another hit on that price line, and the market continues. Okay, so you have 1, 2, 3. Your entry is either here or at the break of your neckline. Okay, and then your TP TP1 would be Y, and so forth and so forth. Then the other one is the inverted head and shoulder. So at the point of exhaustion or the peak stage of your downtrend, you may get this. You have the shoulder, the head and the shoulder. So the break of your neckline should be your good entry. If you, of course, are BTMM trader, you can spot this entry here or this entry here. Your first TP is the height of that head, the head. So you measure this. Let's call it Y again. So your first TP should be Y, and then you can keep adding as the trend continues. And the last one on this group is what we call the falling wedge. The falling wedge. So at this point here, the market is coming from the top, and then you have this channel that is narrowing at the end. So the market gets in there, and when it gets at that narrow point, it breaks, retests, and now shifts from the sell side, it shifts to the buy side. This is what we call the falling wedge. Now, these are the bullish reversal patterns. They happen at the beginning. At the end of a downtrend, gives the beginning of a buying trend. This is what I'm saying. Level 3 of a sell trade. Level 3 or stage 3 of a sell or a selling trend is actually level 1 of a buying trend, after, of course, the bullish reversal patterns. Now let's talk about the last group or the last category in this session. This will be the bearish reversal patterns. The bearish reversal patterns. Now, for the bearish reversal patterns, they are found at the top. They are found at the top stage of the uptrend. So you've been having an uptrend that has higher, high, higher, higher, high. Now, at the top here, stage 3, okay, or the peak, or what you call exhaustion stage of the uptrend, that is where you want to find your bearish reversal patterns. If they are not found on the exhaustion stage, then they do not qualify to being bearish reversal patterns. Well, some of them are, one, we have the double top. So you have 1, 2, looks like an M formation for the BTMM trader. Your entry, of course, is at the break of that, but if you're a BTMM trader, you can actually catch it from the second leg. Your stop loss, if you got it from here, that should be 50%. 50% of this. If you're a BTMM trader, that would be 5 to 10 pips above the second leg. The other one will be the triple top. This is where the market, instead of coming down on the side, goes back to hit the top for the third time, and then now goes down. So entry again, break of neckline, or if you're BTMM trader again, you can hit it from the third point of that, the third hit from the top. Your stop loss goes 5 to 10 pips to the top. If you got it from here, your stop loss goes at the 50% point. Your TP, of course, will be your first TP is this this part here, the length we measure here. That should be the first TP, and then you can add on as the cycle continues. Then we have the obvious head and shoulder, the most common one of the exhaustion points, especially for the dollar and other pairs. This is very, very common. Head and shoulder with the break of the neckline, you get your entry. Again, this favors the market maker traders really well, so you can get your optimal entry from here or from the second leg. Your first TP, if you measure this part here, call it Y, that should be your first entry. You can triple your I, so your TP1 is the Y, TP2 is Y2, TP3 until maybe you get to the end stage of that cycle. And then we have the rising wedge. The rising wedge, where the market gets into a channel that is narrowing to the top side. So the market is coming from bottom side, now gets into that, and when it gets to the narrow point, it breaks to the bottom side, retest, and continues descending. So this is a rising wedge. It's rising to the top side but narrowing at the end. Now that's the difference between a wedge and a flag. Okay, very, very important. For the rising wedge, it's expected to narrow at the end, but if it was a flag, then this would be equal distance. So there will be no narrow. So these are some of those important chart patterns. Remember, there are so many chart patterns. There are so many chart patterns. There's also the diamond chart pattern. There's also the rounding bottom. Okay, and then if you have a retest, you can call it a cup and handle. Then the market goes. The opposite would be the rounding top, and if it has a retest, we call it the cup and handle. We also have the diamond, where the market still gives a shape like this. So you have the diamond type of chart pattern. And then it breaks or retest, we continue. Or if it breaks, retest, we continue to the downside, depending on where the market is coming from. So there are so many chart patterns. What I've mentioned are the most common, or what we may call the most important ones. You're going to find them on all your charts. Now, how do you draw them, or how do you identify them on your chart? So when you open your chart, it can be on any time frame, but they are heaviest if they are on a higher time frame, okay, or they are stronger, or they are more probable, or the probability is higher if you find or if you spot them on the higher time frame. So what you want to do when you get a range, when you get a range, or the market is going in a consolidative manner, you want now to have 2 points. Very important. Just join a line at 2 points at the top and 2 points at the bottom. Let it flow. Now, whatever pattern that is, it will be shown depending with how it will show up. So get your 2 points, draw a line, get your 2 points, draw a line. If it's the head and shoulder, of course, you can just draw your lines and see. If you're on the daily or any other time frame, of course, anytime you see a reactive move or a slow move, pick the first and the second, just draw. It's a matter of just drawing lines, okay? It will guide you. The pattern will just show up somehow. Just pick 2 points. When the market goes reactive, just pick 2 points and draw. Make it perfect. How you get to know the break? Of course, you want to have a significant candlestick. Now look at this huge green candlestick here that broke to the top. You don't chase it and start joining the trade from here. No, it's important that you wait for a retest. And while you're waiting for a retest, if it's on a bullish, if it's a bullish, this is the middle, this is the first stage, this is the middle of the state of the trend before you get to level 3 or stage 3. Here you want to have a bullish continuation pattern. So what will be your extra conference? It will be a price action movement here. You want to see bullish price action, or better still, you want to see a bullish candlestick pattern. And of course, here you see we have this beautiful engulfing, bullish engulfing that was retested, and the market went stronger to the top side. Now, this is what I was mentioning, or what I had highlighted, that the retest makes your move even stronger. The retest, look at this area here, the one that I have highlighted. Let me change that color to, okay. Can you see this part here? This is the most important part whenever a pattern has been broken, or anytime there's a breakout. This is the most important part, where you now pay attention to the candlestick patterns happening after the break. After the break, kindly, if you can just focus on taking patterns that have been retested, then you'll be taking very high probability trades, or what we call high volume trades, and your losses or bad trades will be totally minimized. Why? Because if the price action goes against the break, then you know that break was a false break. Of course, in the next video, I'll be highlighting characteristics of a false breakout and what to look out for. But basically, pay attention to every break. May it be a triangle, may it be a wedge, may it be a flag, a pennant, whatever pattern that shows up on your chart, pay attention. One, to the location where it's found, where it has shown up, and again after the breakout, the price action around that breakout. Now, guys, it's your work to pick any of your favorite patterns, the ones that you liked most. Okay, you can also use Google to get more. Okay, or you can use the list that I have highlighted on the notes. Okay, you can find either of these on your chart. Pick the one that comes easy to your brain, of course. Then back test by looking for the same chart pattern on your favorite candlesticks, on your favorite tradable items. Sorry, remember, you do not have to master all of them. All you have to do is pick a few that you feel are easy to you, and then you can use them. Now, what are the notes or those important little or minor things that you really need to have at your fingertips, sorry, your fingertips when you're considering trading chart patterns, or you're considering using chart patterns. One of them is, for extra confirmation, there should be a volume spike. Now, this is very, very important. For extra confirmation, there should be a volume spike with the breakout. There must be a volume spike with the breakout. If there's no spike, then that's a false breakout. Now, everyone will be asking me, what is a volume spike? Let's say you're using TDI. Let's say you're using TDI. You want to see what we call a shark fin. So if it's from a sell side, you want to have this. If it's from the buy side, you want to have this, or what we call the outside structure. You can call it a shark fin, or you can call it an outside structure. So this is what you want to see. If also you're using RSI, of course, you're going to get the same thing. This is what we call the volume spike, telling you, hey, there was so much volume that just spiked. That's what we call the volume spike on any of your indicators, especially the RSI and the TDI. For me, of course, I'm betting on the TDI, and if you do not know how to use TDI on your trading, I have a video for that. We have the TDI strategy, so make sure that you watch this video. Make sure that you watch this video to learn how to use TDI on your trading. Okay, something else to note is, of course, wait for a retest after the break to join the trade risk-free. Instead of getting so much drawdown, just sit on your hands retry. Sit on those hands retry and wait for a retest. The retest will help you, one, to flex your muscles on those lot sizes, because a retest gives you optimal entry. Therefore, you don't have to suffer much drawdown or any drawdown at all if you've been watching or nursing your chart work. Then number 3, for the head and shoulder patterns, if found at the middle of the trend, is safer to trend trade. This is what I'm saying. Suppose I'm on a buying cycle. Then on stage 2 here, I find a head and shoulder. Or this will be an inverted head and shoulder because I'm on the buying cycle. So at level 2, then I find an inverted head and shoulder. Am I supposed to take it as a reversal or something? No, it's actually extra confirmation that I'm expected to go to the top side. If I'm on the selling cycle and on stage 3, I encounter a head and shoulder, what am I supposed to do with it? I'm supposed to continue with the trend. So basically, that's what point number 3 is saying. For the head and shoulder patterns, if they are found at the middle of the trend, it's safer to trade. Don't start getting scared like, oh, it's supposed to be a reversal pattern. Why is it at the middle? Again, I've said these patterns work depending with the location they are found. Location is key. So if they are found at the middle, they become continuation patterns. If they are found at the extremes, of course, they become the reversal pattern. Point number 4, for the bullish wedge, if found at the end of a downtrend, it's a signal for reversal. Okay, for the bullish wedge, if it's found at the end of if it's found here, then it's a reversal pattern. But if it's found at the middle of an uptrend, again, it's a continuation pattern. Same thing, if a bearish wedge is found on a downtrend, it's a continuation pattern. So if a bearish wedge is found at the middle, if it's found here, you're continuing the selling cycle. But if it's found at the top of an uptrend, now it's a reversal pattern. And the last one is pennants. If pennants are found at their best if they are found at the middle, okay? They are best if they are found at the middle of the trend. Now the pennants, they are more or less like the triangles, eh? Okay, something like this. So if they are at the middle of the trend, they are best. They are awesome. Okay, they are awesome if they are found at the middle of the trend. So guys, there are so many patterns to work on. Now it's your work to back test on the few that I've mentioned. I've just mentioned the most important ones. You can of course add to your list depending with what works best for you, but I've picked the most important ones. Go to your charts, join in any 2 points anytime the market is pushing in a reactive manner. Identify the pattern and wait for that break and sit on those hands until you get the retest, then join in the market risk free. Don't forget, if you're new on my channel, be kind to subscribe, watch the other videos, share with me your feedback, let me know what you'd want me to include in the next session. And don't forget to share the link for any of the videos that you like, or just share the link for the channel itself. For feedback, interaction, and questions, find me on the page on Forex Exploits Online Academy. This is the same page where you get to access personal mentorship, and of course, for people who are self-training, you can get either of my 6 ebooks. Okay. Now, until the next session, I want to wish you the very best. I wish you happy trading time. Until next time, I'm Wanjiru Kishangi. Bye bye.